What's up, guys? I'm Nobody Special. And another day, another Chinese developer defaults on a bond payment. Today, it's Modern Land missing a payment on $250 million US in bonds. There is no grace period on these bonds, so they are immediately in default. This comes despite the repeated assurances from the comedians that run these companies that everything is okay, and of course these adorable characters from the Chinese Communist Party that they trot out to rest assured that everything is okay and there's no contagion risk and all is well in the Chinese economy. And as we're going to see from what's quickly becoming one of my favorite feeds on Twitter, it's the Chinese banks that you need to watch out for, not so much those developers. You ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm Nobody Special, and another Chinese developer has gone into default. Today, it was Modern Land. They had a $250 million bond payment due yesterday, and they missed that payment. There is no grace period on that bond, so they are immediately in default. And Modern Land had warned of this last week in their attempts to restructure this bond payment to delay by 3 months. When those negotiations fell apart, it became pretty clear that this is going to happen. Now, this comes as last week Evergrande very surprisingly made their bond payment just 2 days before they entered into official default. They were on day 28 of a 30-day grace period. Of course, their next 30-day grace period runs out of time in 3 days on the 29th, and they have another bond payment due. We'll see if they make another last-minute Hail Mary and make that bond payment. But as you're going to see from the last bear standing, which is quickly becoming one of my favorite feeds on Twitter, it's not Evergrande and it's not the developers that you need to be watching. It's those Chinese banks. Now, before we get into the details, guys, I have to ask, could you please give me a big thumbs up, subscribe to my channel, and hit that notification bell? It really helps me out. And with that, we are going to shrink my big fat melon of a head and get into the nitty of the gritty. All right, property shares drop after Chinese developer Modern Land misses bond payment. This is dated today. Modern Land defaulted on a bond payment, the latest Chinese property developer to do so, adding to worries about the wider impact of the crisis at behemoth China Evergrande Group and weighing on shares in the sector. Modern Land said in a filing on Tuesday that it had not repaid principal and interest on its 12.85% senior notes that matured on Monday due to unexpected liquidity issues. The bond has outstanding principal of $250 million. And as I've said before, if you ever see something, a safe investment promising you a yield of something like 12.85%, run. Okay, there is no such thing as a safe 12.85% yield. That means your principal is at risk. Don't let those high yields draw you in. Again, not a financial advisor, not financial advice. Do your own research, your own DD, and arrive at a decision that is right for you. All right, and so what has happened after this? Well, Fitch has immediately downgraded Modern Land to restricted default after missed payments. Fitch Ratings has downgraded Chinese property developer Modern Land to RD, or restricted default, from C, as the company failed to repay $250 million of outstanding senior notes due October 25th. There is no grace period for the bond payment. And as we've mentioned before in other videos, an RD, or restricted default, means they've experienced an uncured payment default on a material financial obligation but has not yet entered into bankruptcy filings, administration, receivership, liquidation, or other formal unwinding procedures. So that means they are basically bankrupt, although they have not formally entered bankruptcy. And just as a quick recap, there is no shortage of these Chinese developers that are in default or on the brink of default. We're all familiar with Evergrande. We've talked about that. And we've talked about Fantasia in the past because Fantasia defaulted on a bond 2 weeks ago. And we've got the China Properties Group that said this month that its development subsidiary Cheergain Group had defaulted on $226 million worth of payments. And then we just talked about Modern Land. And we've also talked about Cynic Holdings, who is likely to default on their $250 million. And then there's Kasia, and there's Sunak, and there's all these other companies, right? There is just a laundry list of these developers, and they're going down one by one. Again, it is not just the developers you need to worry about, because I also found this story today. This is a quiet little story, didn't get a lot of headlines, but this is on NASDAQ. Chinese estates to book $37 million loss from sale of Kasia bonds. Now, Kasia is one of the companies that we've talked about that hasn't gotten a lot of headlines, but Their shares have been selling off and their debt has been selling off as if the market is telegraphing that they're one of the next ones to fall. Chinese Estates Holding Ltd. said it would book a loss of $37.1 million US in the current fiscal year from its latest sale of bonds issued by Chinese property developer Acacia Holdings. The Hong Kong-based property developer investor sold an aggregate amount of $55 million of notes issued by Acacia for $13.9 million. And therein lies their losses. So they are cutting their losses, they're getting out, and I can't help but feel sorry for whoever bought those notes. Even though they got $55 million worth of debt for $19 million, something tells me that they are not going to get that $19 million back. Now, we've been talking an awful lot about the developers, and I've been highlighting the developer stories one after another, all of these guys failing on their bonds, and will Evergrande default, and won't they, and how much time is left on the clock. Now, while all the attention is on Evergrande and is on these developers, you need to keep in mind that it is the Chinese banks. It's the Chinese financial system. That is the real risk. And there is this individual on Twitter, the last bear standing, who I've been following really since the Evergrande story broke. And I highly recommend his feed. Again, that is the last bear standing. And I'll put a link in the description. I just learned today that he has a Substack page where he puts out a newsletter. And this is showing it right here. It is thelastbearstanding.substack.com. I'll put a link down in the description. He's got an interesting theory about a volatility squeeze that he's been writing about. A lot of that goes over my head, but I have been reading up on it, and he may be onto something. Again, head over to Substack. Give him a follow. I highly recommend it. He has got some very good stuff. Now, normally I wouldn't do this. I wouldn't just read off a long Twitter thread, but I was reading through this thread trying to prioritize what are some of the talking points that I want to cover in this video. I'm sitting here making footnotes and I'm highlighting almost the entire thread. Bears repeating. So I want you guys to bear with me here because there is some really good stuff in here. Okay. First, he's saying pressure cooker, China update, and this is dated today. Too long, don't read. Stop focusing on Evergrande's interest payments and start thinking about the banks. Back in June, now I'm quoting him here. Back in June, I described credit contagion as a tail risk. Then in July, I said it was a given that Evergrande was effed and pointed readers to the likelihood of contagion for developers, financiers, and the housing market. Since then, contagion has been on full display. As a bonus, I also described Tether as a significant shadow bank that was providing funding into China's commercial paper market, a link that could be destructive both to that funding market as well as the crypto ecosystem. Keep your eye on that Tether story. I've mentioned that a couple of times. That is out there, and anybody who's going to get into the crypto space needs to understand the risk that Tether poses to the cryptocurrency market, which includes Bitcoin, Ether, all the altcoins, everything. You must do your research on Tether. Okay. Moving on. Each of these events has played out as predicted and are accelerating. Yet despite this, there has not been any major disturbance in Chinese or international financial markets that could be considered a crisis. Does this prove that the worst case warnings were overblown? All right, now here's where we're getting into it because it's been a few weeks and we still don't have the crisis, right? We haven't had the big collapse, the pictures of people with their boxes of things, the people crying outside the building. That hasn't happened yet. And what Last Bear is saying is just because that hasn't happened yet doesn't mean we're in the all clear. And a lot of, especially American financial press, for some reason has been very eager to declare this story over. And it's not. So reading on, we get, no, as I've argued repeatedly, systemic risks never sat with developers, but rather with banks. If that last domino falls, there will be a crisis. If not, then the path is more likely a prolonged slowdown that drags on the economy for years to come. My minority opinion is that bank failure is likely given the frozen property market. Lack of new financing to support developers and huge exposure by banks already stretched by non-performing loans. Support is below. Now, I'm not going to read into these threads, but there's a lot of information he has in here from back in September about these non-performing loans at a lot of these banks and how they're just kind of being carried on the books or being hidden from the books in this off-balance sheet activities. There's that buzz phrase again, off-balance sheet. It's how they hide their losses. So I'm not going to read into that, but I highly recommend you check out this channel and you read this stuff in detail. Also, Last Bear Standing, he states that he has a minority opinion. I'm not so sure how minority that opinion is. Just because the financial press is going out there towing the party line that there's no contagion risk and everything is fine, invest in Kathy Wood and buy high-flying tech stocks and never look back, I'm not so sure most investors agree with that. I'm not sure you're really in the minority, Bear, here. I certainly agree with you. The majority opinion suggests that the Chinese banking system is impervious to disruption, regardless of the scale of the problem, and the scale is massive, given central control and the notion that Beijing would not be stupid enough to allow the crisis to happen. To me, this is counterintuitive in light of the circumstances. It suggests authoritarian regimes are immune to economic crisis, as they can be managed away indefinitely with little consequence, and that the Chinese financial system is robust and transparent to regulators. Okay, Bear is hitting on a huge point here. And I tell you, I have so many times in the last few weeks just slacked my forehead at some of this stupidity that I've seen on CNBC and Bloomberg and these talking heads in the press, where they are just like kissing the feet of these draconian Chinese Communist Party people saying, oh, China's got this. Are you kidding me? Their system is so tightly run and they're so all controlling that they can just come in and say no at any time and wave their magic wand and everything goes away. Well, value doesn't get created that way, okay? And the fact that the Chinese Communist Party is basically unlimited in its ability to wield power, that is not a good thing for the Chinese financial system. Because as I like to say, their ability to screw things up even more is unlimited. It's not that their ability to fix things is unlimited. They're going to screw it up more. And if there's one thing central planners and central bankers and these overarching governments do time and time again throughout history, it's make things worse. And that's what China's going to do. They're going to make things worse. And in the next few tweets, Last Bear Standing makes exactly that point. Recent regulators' action has been to inspect banks, reinforce prudent practices, and punish bad actors. While this is helpful long-term, it shows how far behind they are in identifying and addressing problems, and in the short time, it only puts more pressure on banks. If the system was reliant on non-prudent practices, a move to prudent practices will only limit credit extension. Harsh individual punishments will make it harder to coax well-positioned banks to help their struggling peers in an effort to avoid blame if things go bad. And that's the big point there. Harsh individual punishments will make it harder to coax well-positioned banks to help their struggling peers in an effort to avoid blame if things go bad. And I want you to think there's been these recent stories about how the founder of Evergrande, the Chinese government has basically said, take your personal money and fix that problem. Which, I mean, the guy screwed up his company. I'm not feeling bad for this guy. But if you're the CEO of the next bank and you're in a position to help Evergrande out of their trouble by making some investment or a cash infusion, are you going to place yourself personally in the crosshairs of the Communist Party by coming to Evergrande's aid? And now you have assumed that risk, not just to your business, but yourself personally? Does that make people want to help? Absolutely not. And as we saw during the repo crisis that led up to the financial collapse in 2008, it was when the banks tightened up, when they started covering their own butts, and when they stopped lending to each other, that's when everything fell apart. And what the Chinese regulators are doing with their draconian response is they are scaring these banks out of helping each other. And they're making things tighten up. They're doing exactly what we did in 2008, but they're doing it faster, and they're doing it harder. And here's some examples of that. The post-mortem on Huarong, pardon my pronunciation, bailout demonstrates this clearly. With regulators sending agents into all the top institutions to inspect their finances, no one wants to take the fall by trying to help others. The stakes are getting higher and the rules are getting tighter. Many expected an RRR cut, that is, reserve requirement ratio. But an RRR cut merely allows banks to take on more leverage. It does not help a system already over-leveraged on bad debt. Rather than a cut, the People's Bank of China issued a list of systemically important banks for which capital requirements would be raised. So, while a lot of the folks in the banks were expecting the government to ease off on the restrictions, what the government did was they tightened the restrictions further. They brought these banks closer to failure. The PBOC recently broke their silence, insisting that e.g. Evergrande is contained, that financial risk is manageable. I view this as a sign of how bad things are, not a reassurance that all is well. A list of systemic banks means regulators are worried about risks despite headlines. And I agree with that sentiment exactly. I think the more they talk, the more they go out there and assure us that everything is all right and all is well, the worse things really are. That's the one thing I think you can bank on coming out of the CCP, is that they will telegraph their weakness by assuring you everything is okay. And it is almost to the point of comedy the way they do it. Look to them to deflect more anger to the West also as they do this. And also, on a side note, keep in mind what happened with the Falkland Islands when things got bad in Argentina. All right? When draconian governments have economic problems, they like to deflect public anger away from themselves, and starting a war over an island seems like a pretty popular choice a lot of these dictators have chosen in the past. So keep your eye on Taiwan. The unexpected Evergrande interest payment, as well as reports of project construction resuming, also suggest that the company and sector may be getting more backroom support than has been reported. Will this be enough? Last week, the People's Bank of China began injecting 100 billion yuan daily into the system. That's about $16 billion a day. And increased this level to 200 billion this week, or about $32 billion a day. An unusual change from the past, away from the holidays. Moving from a tight policy to substantial daily injections suggests real stress under the surface. And what that is the banks in China not lending to each other. The market is getting so tight and the banks aren't lending to each other, so the central bank is coming in and they are printing money and they're injecting it into the system. Does this sound familiar? This is what happened in 2008 during the great financial crisis. The banks were too worried about the risk. Nobody wanted to be holding the MBS bag or the bad collateral when the music stopped, so they stopped lending to each other. And that's why the banks started to fail. And you're seeing the same thing going on in these Chinese banks. They're not lending to each other because the collateral that they're using for these loans is too tied up in the property sector. It's these junk bonds or mortgage-backed securities or who knows what. And in summary, I will leave you with this. A $50 trillion nuclear bomb is detonating in the banking system. $50 trillion, that is reference to the size of the residential real estate market in China. My view, the minority, is that the pressure will continue to build until something breaks. Central intervention will be reactive to this breakdown rather than proactive in preventing it. Hopefully, I'm wrong. And Bear, thank you for the fantastic content on Twitter, and I don't think you're wrong, and I'm not so sure you're in the minority. Certainly not when it comes. I certainly agree with you. So long story short, the developers continue to fall like dominoes, but that is not the story you need to be focused on. You need to be focused on the Chinese banks, because the Chinese banks are already starting to tighten up their lending to each other, and that is the early indications that somewhere down the line, something big is going to break, because that's what happened here during the global financial crisis. The banks stopped lending to each other. They tightened up because nobody wanted to be holding that lousy collateral when the music stopped. And eventually that caused the music to stop. And we're already starting to see that with these PBOC cash injections into the system to try to keep the lending moving. Anyways, guys, that's all I have for you today. Again, check out The Last Bear Standing on Twitter and on Substack. I'll put a link in the description down below. That guy has fantastic content, and I think we will be hearing more from him in the future. I want to thank you guys for your time. Thank you for watching this video. As always, don't forget, hit that big thumbs up, subscribe to my channel, hit that notification bell. Until next time, live small and dream big.